Alright everyone, let's get straight into it. If you're a high earner in the US, you already know the taxman cometh, and he cometh with a pretty big shovel, looking to take a hefty scoop out of your income. The more money you make, the more complex your tax situation becomes, and the more the IRS is interested in what you're doing. Understanding tax laws isn't just about compliance, it's about maximizing your savings. Not understanding these rules is like watching your hard-earned cash float away. This money could be reinvested, saved, or used to build more wealth. Paying attention to this stuff is crucial if you're serious about your finances. Everything we discuss is legal, and based on using the US tax code to your advantage. This isn't about finding loopholes. That's a recipe for disaster. Instead, we're focusing on smart, strategic financial planning. The government offers tax incentives for things like saving for retirement. It's your job to know what those incentives are and how to use them effectively. Think of the tax code as a complex rulebook for a game, and we're here to learn how to play that game to win legally. So, what's on the agenda today? We're going to break down some of the most effective tax strategies specifically for high-income earners. We'll dive deep into tax-advantaged accounts like your 401(k)s and IRAs, exploring how they can slash your current tax bill while building your future nest egg. Then we'll talk about itemizing deductions, because for many high earners, the standard deduction just doesn't cut it. We'll also touch upon the significant tax benefits of real estate investing, how charitable donations can be a win-win for your portfolio and your community, and even the tax advantages of starting your own business. Each of these strategies, when implemented correctly, can lead to substantial savings, year after year. The bottom line is this. The difference between someone who keeps a significant portion of their high income and someone who sees a massive chunk disappear to taxes often comes down to knowledge and proactive planning. This isn't just for the ultra-rich. It's for anyone who's earning a good income and wants to be smarter about how they manage their money. Failing to understand and utilize these strategies is, quite frankly, a massive financial mistake. You work incredibly hard for your money, so it's only logical that you'd want to keep as much of it as legally possible to put towards your own financial goals, whether that's early retirement, building a legacy, or simply enjoying financial freedom. Let's get into how you can do exactly that. First up, let's talk about one of the most powerful tools in your tax-saving arsenal, the 401(k). If your employer offers one, you absolutely need to be paying close attention to it. A 401(k) is an employer-sponsored retirement savings plan, and its primary magic trick, especially the traditional 401(k), lies in its pre-tax contributions. What this means is that the money you elect to contribute comes directly out of your paycheck. Federal, and in most cases, state income taxes are calculated. This immediately reduces your adjusted gross income, or AGI, which is the number your tax liability is based on. Think about it. You're getting an instant reduction in your taxable income just by saving for your own future. It's like getting an immediate return on your investment. Now, the IRS isn't going to let you shelter unlimited amounts of money this way, unfortunately. There are annual contribution limits, which tend to increase slightly most years to keep up with inflation. For 2023, for example, the limit for employee contributions is $22,500, and if you're age 50 or older, you can contribute an additional $7,500 as a catch-up contribution. For high earners, making a serious dent in your tax bill often starts with trying to max out this contribution. Every single dollar you contribute up to that limit is a dollar that isn't being taxed at your highest marginal tax rate. If you're in a 32% or 35% federal tax bracket, that's a significant immediate tax saving on every dollar contributed. But wait, there's more. And this part is crucial, the employer match. Many employers will match a certain percentage of your contributions. For instance, they might match 50% of your contributions up to 6% of your salary, or even a dollar-for-dollar match up to 3% or 4%. This is literally free money, people. It's an immediate, guaranteed return on your investment that you simply cannot find anywhere else. If you are not contributing at least enough to get the full employer match, you are, without a doubt, leaving part of your compensation package on the table. It's like saying no thanks to a pay raise. For high earners, the match might seem small relative to your income, but it's still free money that compounds over time. And speaking of compounding, let's not forget about tax-deferred growth. Once your money is inside the 401k, any investments you choose, stocks, bonds, mutual funds, grow tax-deferred. This means you don't pay any taxes on the dividends, interest, or capital gains earned year after year. This allows your investments to compound much faster than they would in a regular taxable brokerage account, where you're constantly getting hit with taxes on your gains. Imagine the snowball effect over decades. The difference can be absolutely massive. You only pay taxes on the money when you withdraw it in retirement, hopefully when you're in a lower tax bracket, though that's not always the case for diligent savers. All right, let's move on to deductions. When it comes to reducing your taxable income, the IRS gives you two main paths: taking the standard deduction or itemizing your deductions. The standard deduction is a fixed dollar amount that you can subtract from your adjusted gross income, AGI, if you choose not to itemize. This amount varies depending on your filing status: single, married, filing jointly, head of household, etc. And it's generally indexed for inflation each year. For a lot of taxpayers, especially those with simpler financial situations, taking the standard deduction is the easiest and often the most beneficial route. The IRS basically says, here's a set amount you can deduct, no questions asked. Well, almost no questions. It simplifies the tax filing process considerably. Itemized deductions, on the other hand, are a list of specific eligible expenses that the IRS allows you to subtract from your AGI. These can include things like mortgage interest, state and local taxes, charitable contributions, and certain medical expenses, among others. You would only choose to itemize if the total sum of your allowable itemized deductions is than the standard deduction amount for your filing status. It's a straightforward mathematical comparison. If your itemized total is higher, you itemize. If the standard deduction is higher, you take that. This is where meticulous record-keeping throughout the year becomes absolutely paramount, because you can't just pull numbers out of thin air. You need documentation to back up every single itemized deduction you claim. So why are high earners often more likely to benefit from itemizing? It generally comes down to the fact that higher incomes often correlate with higher amounts of deductible expenses. For example, high earners may own more expensive homes, which means more mortgage interest paid. They might live in states with higher property taxes or state income taxes, which, even with the SALT cap, can add up. And often, high earners are in a better financial position to make significant charitable contributions. When you start adding up these potential deductions, the total can frequently exceed the standard deduction threshold, making itemizing the financially smarter choice. It's simply a numbers game, and for those with substantial eligible expenses, itemizing can lead to significant tax savings. The key to successfully itemizing, and frankly to not losing your mind during tax season, is diligent tracking and record-keeping throughout the entire year. Don't wait until April to try and reconstruct a year's worth of expenses. Use accounting software, budgeting apps, spreadsheets, or even just dedicated physical folders for receipts and statements. Keep track of your mortgage interest statements, Form 1098, property tax bills, records of charitable donations, both cash and non-cash, and any significant medical expense receipts. This isn't just about finding every possible deduction. It's about having the necessary proof to substantiate those deductions if the IRS ever decides to take a closer look. Being organized is half the battle won. Alright, let's dive into what I consider one of the most powerful, yet often misunderstood tax benefits out there, especially when it comes to real estate depreciation. Now listen to this, because it's absolutely incredible. Depreciation, in the eyes of the IRS, is the reduction in value of an asset over time due to wear and tear, usage, or obsolescence. For real estate, specifically your rental building, the IRS allows you to deduct a portion of its cost each year. This isn't cash leaving your pocket annually for this specific deduction. It's a phantom expense that exists on paper, purely for tax purposes, and it can save you a fortune. Many people get confused because their property value might actually be going up, but the structure itself is considered to be wearing out. Get this. The way it typically works for residential rental properties in the US is through something called the straight line method over a period of 27.5 years. For commercial properties, it's generally 39 years. So, you take the value of the building, and this is important. It's the building, not the land, because land doesn't depreciate, and you divide that by 27.5. That resulting number is an expense you can deduct from your rental income each and every year for nearly 3 decades. Imagine that. A consistent, predictable deduction working for you year in, year out, reducing the amount of your hard-earned money that's subject to taxes. It's like an annual tax discount courtesy of your investment property. Now, here's where the magic really kicks in, especially for high earners. This depreciation expense directly reduces your taxable rental income. Let's say your property generates $20,000 in net operating income before depreciation. If your annual depreciation deduction is $10,000, guess what? You're only paying taxes on $10,000 of that income. It can even create a situation where, on paper, your property shows a tax loss, even if you're collecting positive cash flow every month. This isn't some sneaky loophole. It's a legitimate IRS-sanctioned deduction designed to encourage investment in housing and infrastructure, and you should absolutely be taking advantage of it if you own rental real estate. For high earners, this is an absolute game changer. Why? Because it shelters your rental income from those higher tax brackets. Think about it. You're earning income, your property is hopefully appreciating in value, and yet, thanks to this non-cash expense called depreciation, your tax bill on that rental income can be significantly lower than you'd expect. This is one of the core reasons why so many wealthy individuals and savvy investors are heavily involved in real estate. It's not just about the bricks and mortar, it's about the incredible tax efficiency it offers, allowing you to keep more of what you earn and build wealth faster. It's a strategy you simply can't afford to ignore. Alright, let's dive into Chapter 5, and this one, believe it or not, is all about charitable donations. Now, I know what some of you might be thinking. Charity? Graham, are we here to talk about feelings or finances? And the answer, as always, is both. Charitable giving isn't just about supporting causes you believe in, it's also a way to reduce your taxable income. It's a win-win where you can do good for the world and your bottom line. Donations must go to a qualified 501(c)(3) organization to be deductible. Verify the organization's status using the IRS tax-exempt organization search tool. Cash donations are straightforward, but donating appreciated assets can be smarter. You can often deduct the full fair market value and avoid capital gains tax. Be aware of AGI limitations: 60% for cash, 30% for non-cash assets. Plan your giving strategically to optimize your deductions. Okay, moving on to Chapter 6, and this one is a big one for those of you who are entrepreneurial, or even just thinking about a side hustle, starting a business. When you're a W-2 employee, your ability to deduct expenses is pretty limited. You get your standard deduction, maybe a few itemized things, but that's about it. But the moment you start a business, a whole new universe of potential deductions opens up. Suddenly, expenses that were personal costs can become business write-offs, reducing your taxable profit. It's a fundamental shift in how you approach your finances and taxes. But remember, the IRS has the hobby loss rule. You must have a genuine intent to make a profit. So yeah, you actually have to try and make money, people. If the IRS suspects your business is a hobby, they can disallow those losses. They look at factors like whether you conduct the activity in a business-like manner, your expertise, the time and effort you put in, your history of income or losses, and your financial status. It's not just a magic wand for deductions. When you do decide to start a business, one of the first things you'll need to consider is its structure. The most common and simplest is a sole proprietorship, where you and the business are essentially the same for tax purposes. The real beauty of having a business, from a tax perspective, is the mindset shift it enables. You start looking at your everyday expenses through a new lens. Is this in any way related to my business? That new high-performance laptop you need, if it's primarily for your graphic design business, that's a potential deduction. A portion of your internet bill, your phone bill? If you use them for your business, part of that can be deducted. Even a portion of your home expenses, if you qualify for the home office deduction, which we'll talk about. It's about legitimately allocating costs to the entity that's designed to make money, your business, rather than just absorbing them all as personal, non-deductible expenses. All right, everyone. We have covered an absolute mountain of information in this video, from leveraging tax-advantaged retirement accounts like your 401ks and IRAs to the nitty-gritty of itemizing deductions versus taking the standard. We explored the powerful tax benefits of investing in real estate, how strategic charitable donations can reduce your taxable income while doing good, and just now, the incredible potential that starting your own business offers for unlocking a world of deductions. My goal here was to open your eyes to the possibilities, to show you that as a high earner, you have options when it comes to managing your tax liability intelligently. It's not just about how much you make, but how much you keep, and these strategies are key to that. Now, it's super important for me to say this, and I say it all the time. I am not a CPA, I am not a tax advisor, and this video is for informational and educational purposes only. Please do not take this as personalized financial or tax advice. The tax code is incredibly complex. It changes all the time, and what works for one person might not work for another, or could even be detrimental. Your financial situation is unique. Your income sources are unique. Your goals are unique. Therefore, the strategies you implement need to be tailored specifically to you. Think of this video as a starting point, a way to get you thinking about the right questions to ask. So, what is the single most important takeaway from all of this? It's that you absolutely, positively should consult with a qualified tax professional, a certified public accountant, CPA, or an enrolled agent, EA, who has experience working with high-income individuals. These professionals live and breathe this stuff. They can analyze your specific financial picture, understand your goals, and help you develop a comprehensive tax plan that legally minimizes your tax burden and aligns with your overall financial strategy. Investing in good tax advice is not an expense. It's an investment that can pay for itself many, many times over. Don't try to navigate the labyrinth of the US tax code alone, especially when the stakes are high. And with that, thank you so much for watching all the way to the end. I really hope you found these strategies insightful and that they've given you some actionable ideas to discuss with your tax pro. If you enjoyed this video and want to see more content on how to save money, invest wisely, and build wealth, please do me a huge favor and smash that like button. It really helps the channel out. And of course, subscribe and hit that notification bell so you don't miss any future videos. Drop a comment below with any questions you have or topics you'd like me to cover next. I read as many as I can. Until next time, keep working hard, keep being smart with your money, and go crush it.